Like I said, welcome to the webinar. We've got a good one today for you. We are recording this session, so you will all receive a recording of this session as well as a copy of the slide deck a little later today. We are also using the Q&A box for questions. We have disabled chat so that we can get all of the questions in one area for us to go through and to try to answer all of your questions for you. So please use that throughout the presentation today. So I'd like to turn it over to Tim Tukulski, our real estate guy, who's going to get us kicked off today. Take it away, Tim.
All right, well, thank you very much, Jennifer. And of course, my dogs just went off barking right at the time I'm supposed to go on, but good morning, everybody. So we are talking about post Proposition 19 planning, because as many of you may know, Proposition 19 effective date was actually yesterday. So if you wanted to take advantage of the law prior to the effective date, you had to do something before that date. And of course, if you had any inclination to do that and tried to find an attorney or a planning person that would help you with that, it was almost impossible to do that. So we decided that rather than try to cram everything through by the effective date, we thought, why not do something on post effective date planning, which quite honestly is a lot of the techniques that we already had available to us. So we'll be running through that, so not the end of the world if you didn't do something. In fact, maybe even smarter to slow down and make this part of your overall estate plan. So again, my name is Tim Tukulski. I am a CPA and principal with Sensiba San Filippo. I head our real estate group. I am joined today by, and I'm trying, there we go. So use the up and down arrow. I'm joined today by Mary Cunningham, who's president of Chicago Deferred Exchange. They're an exchange accommodation company. While a lot of what Mary is going to say today doesn't really relate to Prop 19, we thought it was a great opportunity to bring Mary in and give us an update on the industry while we had your attention on Prop 19. And then, of course, my dear friend Ryan Lockhart, who is a partner over at McKenna Brink. So Ryan and I have been doing business for several years together and primarily talking with clients about property tax transfers and planning and how to avoid that. So a lot of what I have learned in this area comes from Ryan, so I'm thrilled to have him join us on this webinar today. So an overview of what we are going to talk about. So there are really two parts to the Prop 19 legislation. One was the good part, the other one was the bad part. We're going to cover both of those with primarily focus on the second part. As you are aware, it covers the transfer of not only your personal residence, but also the transfer of other real estate. And we'll see how the prop has really limited your ability to transfer property other than personal residence and get that carryover basis on the Prop 13. A couple of techniques that we can use post-effective date that are still viable. We're going to cover those, the use of a limited liability company, as well as the use of an intentionally defective grantor trust. We won't have time to go into a lot of detail on the IDGIT, but we did want to give you a flavor for it as an entity and kind of a preferred tool for estate planning. And then lastly, time permitting, we are going to allow Mary to give us an update on 1031 exchange. We've got some final regs that just came out, and she'll give us a little insight on the legislative update as well. And then I'd like to just remind everybody, I think Jennifer did, but if you have questions throughout the webinar, please use the, Jennifer, I'm not sure if we should use the chat function or the Q&A function, I think in the webinar.
Q&A box.
Q&A box, so. And we will have a couple people monitoring those questions, so we can either answer those through the Q&A, or if it's appropriate to the rest of the group, feel free to give that to the group and we'll answer it live if it makes sense. So. All right, so starting with Prop 19. So this was a bit of a smoke and mirrors, I think, situation when we were voting for Prop 19. I think a lot of people were surprised that there were some bad things with respect to Prop 19. Everybody was focused on the good. So part one of this, I would say this is what everybody voted for. This is what everybody thought they were voting for. The ability to be able to transfer your Prop 13 base by selling your house either in the county or outside the county into another county. There were situations where counties had agreements, some but not all in California, where you could transfer your property tax base. And this proposition was touted as being, you know, the equalizer. We'll make all the counties. You can transfer to any county and get your Prop 13 base. Of course, the criteria is that you must be over 55 or disabled. And there is a provision that allows, if you were a wildfire victim and have to transfer your residence, or I guess get an increase in the base as a result of rebuilding, then that base will be preserved. My understanding is that's just for wildfire. It's not for any other casualty. So, you know, earthquake, I guess you're out of luck. Better run out and start your house on fire. But anyway, so the replacement or the carryover is allowed for 100% of the replacement value, as long as you don't buy up. So a simple example would be that if you're over 55, you're currently in a home that's worth $1 million, your Prop 13 basis is $500,000. If you purchase a replacement property at $1.2 million, that is $200,000 more than your original residence, then your property tax base will be increased from 500 to the 700, which is the extra $200,000 over the fair market value. So again, they're not going to give you a break on buying a more expensive residence than what your current replacement cost is on your existing one. And of course, if you buy down, well, then you'll get the benefit of the carryover on the buy down. I didn't get an example of that, but as you can see, let's just say we bought one for $900,000, you would still have a $500,000 base. Okay, and then secondly, part two of the Prop 19 eliminates the Prop 58 parent-child exclusion. So prior to Prop 19, parents were allowed to transfer their principal residence or another piece of rental property and get either a whole or a partial exclusion on the assessment. Prop 19 has changed that now to say that you can only do that with respect to a primary residence, and the child must live in that residence after the transfer. And there is no longer an exclusion for the transfer of other real property. So again, no vacation homes, no rental homes, no second homes, or no commercial property. So at this point, I'm going to turn it over to Ryan, so he can chime in on anything that I said that might be incorrect in the implementation of Prop 19, and he's going to lead us into a discussion on some ways now to plan around it. So
all right,
take it away, Ryan.
Thanks, Tim. Thanks, Tim, and you got it all right, so feel good about that. One quick note on Prop 19, the good part, if you're over 55, you can transfer to different parts of the state. You can do that up to 3 times now. It used to be a one-time shot before Prop 19, but now you can do it up to 3 times. So don't feel like this is a one-time thing. You have to find your forever home if you're over 55. There is some flexibility now under Prop 19 to be able to transfer your primary residence property tax bill basically to up to 3 times. So that's a good point. So here we are in a post-Prop 19 world, or we're in the Prop 19 world. Really, it's post-Prop 58, but what do we do? So Prop 19, as Tim said, as far as the parent-child component, started yesterday. And so we have this Prop 19, and it's got some good and it's bad. One part that we're definitely waiting on is we are waiting on some guidance from the Board of Equalization on how the state is going to interpret various scenarios. So in these parent-child transfers, there's all these different techniques that attorneys like myself and CPAs like Tim, we counsel our clients, we may recommend, and they can get somewhat complex at times. And we can be clever of like how to try to maximize exemption as we're doing this. So quite frankly, under Prop 19, there's some guidance that we're gonna have to get from the Board of Equalization to see how the state will treat some of these. But the techniques we're gonna talk about today have been in place for a long time. Tim and I have employed these with clients in the past, and it's really using entities. So what I wanted to start with is, let's talk about how did the property tax rules define a change of ownership? Because it's really the change in ownership that triggers the property tax reassessment. And so Revenue Taxation Code Section 60 defines it basically, you have to transfer a present real interest property, or present real property interest. So just like everybody thinks of, you make the deed, you record a deed and you transfer, maybe it's the whole property, maybe it's a percentage of the property. That's pretty clearly a transfer of the property interest. There has to be a beneficial use thereof. So the person that is receiving the interest of the real property, obviously they're going to become the owner. They can beneficially use the property, any way they see fit. And the value of the interest is going to be substantially equal to the fee interest. So some of these terms are like real old legal terms when we talk about property. A fee interest, just think of a property interest. So obviously you're transferring property and I have the right to use it to me. If you transfer it to me, I'm going to use it. And it obviously has some value substantially equal to what that interest is. Why does this matter? Because again, this is how the counties, when they see a transfer, they're going to latch onto that and they're going to say, okay, we are now going to reassess that interest that was transferred, unless there's some other exclusion that applies. There's a couple other exemptions or exclusions that apply to transfers of real property from reassessment. And the FBYV at the bottom here, that's the actual term for your property tax base. It's called your factored base year value. And that's what the county is going to increase if they have the ability to. And I think we're all not surprised to know that pretty much every county in California is very aggressive in looking for property tax reassessments whenever they can. And so some counties are even more aggressive than others, but basically if they see this change of ownership scenario apply, they're going to come in and they're going to assess the property or reassess the property to be able to get increased property tax revenues, which is of course county money. So we can use legal entities. And when I say legal entities, think of limited liability companies first. That's usually the most preferred entity for real estate holding in California, but it could be others. It could be like a partnership, could be a corporation even. So all these are under this umbrella of legal entities. And there's a general rule of what a legal entity is. And this applies for when we're looking to make some transfers of the legal entity itself. So basically, the rule says that the purchase or transfer of ownership interest in the entity itself, such as stock or partnership or limited liability membership interest. Go back one more, Tim. Yeah, is not deemed a transfer of the real property in the entity itself. I'm going to put an asterisk on this. So we can, quick scenario, you're 100% member owner of an LLC, right? You have an LLC that you own, you have property inside the LLC. You can start to transfer the LLC interests instead of the property itself, right? Because the property is still inside the LLC. But you can start to transfer the LLC membership interests, maybe to children, maybe to other individuals. And as long as we don't transfer too much of those interests, that will not be deemed a real property transfer. So it kind of ties back into that general rule of the previous slide that says we're not transferring that present property interest for the beneficial use and the value, equals the interest transferred. We're just transferring LLC interest in this scenario. So, but there's two rules that we really have to look to. And these rules aren't well known. And it's been my mission, as Tim knows, the last 8 or so years to really try to educate people such as yourselves on these two rules. One is called the change of control rule. So we can transfer up to 50% of an LLC, because it's a non-controlling interest, right, to somebody else, and that will not trigger a property tax reassessment. Or as long as somebody does not gain a more than 50% interest, that will also not be a change of control, because the way the change of control rule works is it says as soon as a member gains more than 50%, they have a controlling interest, they can basically vote what's going to happen with the property inside the LLC, right? So now they're in control. The state says that's going to trigger a change of ownership. And once we have the change in ownership, that's when the county gets to reassess. So really a lot of our planning is going to be how much of an LLC interest can we start to transfer, especially in the parent to child context. You know, most of the time, mom and dad own the property. We know the goal is they want to transfer the property to their children, but they want to try to limit the property tax reassessment as much as possible. Well, mom and dad could form an LLC, put the property into the LLC. Mom and dad are now 100% membership owners of the LLC, and they could transfer up to 50%. One more, stay back there, Tim. They could transfer 50% to their children, and we don't have that change in control because the children have 50%, mom and dad have 50%. There hasn't been a change in control yet. So that's the first rule we have to look at. But there's also this second rule, and that's called the cumulative transfer rule. This one operates a little bit differently, but it's also similar. So when you form an LLC or you contribute property to an LLC, because you own the property before, and when you add it to the LLC, it's called a capital contribution, then you are going to be deemed an original co-owner of that property. Now, they're going to track this separately than the change control rule. So when more than, and more than is a key terminology here, when more than 50% of those original co-ownership interests change, that will trigger a reassessment of that individual property. So how these two rules can work together is we have to make sure we're not going to trip one or both. So let's say same scenario, mom and dad have a property, they contribute it to their LLC that they just formed. They're 100% owners of the LLC, but they're also 100% of those cumulative transfer interests. So if they were to transfer up to 50%, we have not changed control. So we're okay on the change of control rule. And we haven't transferred more than 50% of those original co-ownership interests. So again, we're still avoiding reassessment at that point. Now, you'll notice I'm talking about up to 50%. That's not obviously transferring the whole property. So it's not a full-fledged solution, it's a partial solution. Well, that's when we can start to layer in other techniques to try to transfer more interest in the property, all the while avoiding property tax reassessment. All right, so let's go through a scenario. Next slide, there we go. So here's one potential planning option with an LLC. I'm gonna run through this option and I'm gonna give you some variations along the way that you should consider. Falling back on my example that I've been using, mom and dad, the parents, form an LLC and they contribute the property. They're 100% members at this point. They gift, now it's a gift in my scenario right now, but it could be a sale. But in this scenario, we're talking about gifting. So they gift 50% of the LLC to the children. So then we have parents with 50% LLC interest, children with 50% LLC interest. We have not triggered either of those two rules that I mentioned. So no property tax reassessment has happened yet. Then parents and children dissolve the LLC. So when you dissolve the LLC, there's going to be a deed that's going to transfer the property out of the LLC to parents as 50% owners, to the children as the other 50% owners, all as tenants in common. There's an exemption, property tax exemption, when you do what they call a pro rata distribution from an entity to its owners. That's not going to trigger a reassessment. So when this deed is recorded, the county is going to say, okay, is this a pro rata distribution? Does it meaning did the interest of the property come out of the LLC to the owners in the same percentages that they owned in the LLC? And in our scenario, that's yes. And we show the county, parents for 50%, children were 50%. Now, after the title has transferred via the deed, parents are 50%, children are 50%. So we're still exempted. So what we've effectively done at this step is we've transferred 50% of the property to the children through this LLC structure. And now we have 50% transferred out. A gift has been made, yes, so that's going to be reported to the IRS. But as far as property taxes are concerned, we've accomplished half of our goal, right? We got 50% out. And maybe some clients want to just stay right here. And they say, okay, we got 50% out. That's going to help, but maybe mom and dad don't want to transfer 100% of the property anyways. So they're good with still owning 50% of the property. And then through their estate planning, when mom and dad pass away and that 50% that they owned transfers to the kids after death, maybe that's a good planning tool because, yeah, that 50% is probably going to get reassessed when it transfers to the kids after death. But there's some other tax benefits we might be planning for, such as the step up in tax basis, which I can let Tim talk about if he wants to. So that's one, this is this part of the scenario, but what if we want to go further? And it's really about risk management at this point. How far do we want to push the envelope with the county? How far do mom and dad want to push it as far as their own estate planning needs, right? If there's some cash flow concerns, et cetera. But if the client says, you know what, let's push forward and see if we can get more of this property in the children's hands without triggering a property tax reassessment. All right, so now we're going to say parents and children have 50% ownership interest in the property. Let's reform a new LLC and have mom and dad and the children contribute their interests into this new LLC. Now, this is where we're going to have both of those rules kind of coming into play. But at this point, when parents and children contribute into the new LLC, they're both going to be deemed original co-owners at this point, 50% each. Then parents could start to look at, are they going to do some further gifting of that new LLC? Or maybe it's a part of their estate plan that they want that 50% to be transferred after their death. Whatever that component is, we're still going to not trigger that first change in control rule, because when parents transfer their 50% interest to their children, as long as we have more than one child involved here, we're not going to have somebody gain more than 50% interest or controlling interest. Parents are only transferring 50% of the new LLC, so we haven't triggered a rule or reassessment there. And we haven't transferred more than 50% of the original co-ownership rule interest. So again, we're still not triggering a property tax reassessment. You'll see that I'm saying beware the step transaction doctrine. This is really the only way a county could try to attack this scenario or this planning tool, is they could say, there's this idea called the step transaction doctrine. And it says, if taxpayers run through a series of steps and the only real reason they're doing it is for tax saving mechanisms, and there's no other legitimate reason to do this, then maybe they can collapse that all down into one step and trigger that reassessment. That's a very tough hill for the county to climb, but it is a possibility. So this is why risk management, when we're talking about this part of the planning option, comes into play. But I definitely have employed this technique, and we haven't had any problems so far.
So Ryan, I have a question.
Yep.
Once you're at this point in the plan, and we've transferred 50% of the partnership interests to the kids, and then we liquidate the partnership such that the kids and the parents own a TIC interest, we don't have to necessarily reform a new LLC at that point, right? Can't mom and dad just continue to gift undivided interests, their TIC interest, to the kids?
If they give TIC interests, then those interests will probably be reassessed. So they could. I mean, it could be a mitigation strategy.
Oh,
I'm assuming this is like a rental property or commercial property in this scenario.
Yes.
If it's their primary residence, maybe under Prop 19 we were able to do it if the children are going to live in the home, etc. But if it's a rental or something else, if they start gifting TIC interests, TIC interests, those interests will be reassessed.
Oh, interesting. Okay. And that's a direct result of Prop 19, because I think under the old rules, we could have given the TIC interests and avoided that.
And we did. And under the old rules, we would
gotcha.
give TIC interests away to the children because there was an exemption available for that.
Okay, so you do have to reform. And is there a rule of thumb to avoid the step transaction? Age it? I mean, let's not liquidate and then reform immediately, maybe wait a year.
Yeah, anytime that you can, anytime that you have this type of planning option that you're employing, aging it, as you say, Tim, is definitely recommended. And so this is all of these steps are not going to happen in like 2 months. We're going to say, do the first 3 steps. And then when you get to step number 3, where everybody's owning as tenants in common, then maybe keep it that way for like at least 1 tax reporting period, which could be a full year, maybe it's a partial year, whatever that is. And then as you go into the next reporting period, next reporting year, then that's when you can start to look at the next steps of reforming a new LLC, or maybe starting to do some further gifting at that point. But there's going to be some parts of this where we're going to definitely recommend keep it at this stage for a period of time. Right. And then when we get to the next part, it won't look like it's so close together that the county can clearly see, oh, I know what they're trying to do. And it's also, you're trying to avoid them even really seeing this with a clear eye and get that need to go fight it.
Right. Well, now Ryan did mention that the scenario works with the gift. It actually can work quite well with something other than a gift. So we did want to just present this slide as a couple of alternatives. Number one, rather than just give the property outright to the kids, you could sell the property to the kids. That's if it's income producing and the property can actually cash flow the purchase, great. And in fact, if you do it under an installment sale, there won't be a taxable event to mom and dad on the sale of the property until if and when they collect principal on the note. Of course, would pay income tax on the interest. Sale leaseback scenario. So we did a few of these transactions prior to Prop 19 effective date, where we actually had mom and dad sell their principal interest, principal residence to either their kids outright or to a trust for the benefit of the kids, which we'll go over briefly. Of course, the challenge with that is they no longer own the property. So that if they want to continue to live in it, they're going to have to pay a fair market rent. Well, a lot of you might be thinking, well, that's awfully crazy. Why would I sell my principal residence to my kids and then pay them rent? Well, if you are part of a very wealthy family and looking for ways to reduce your ultimate estate tax liability by transferring millions of dollars of property out, by the way, we've got $11.7 million unified credit amount per individual, over 23 million per couple. Why not use this as a technique for transferring that out? That's what we did. And we not only were effectively transferring out the value and the future appreciation of that property, but the rent that mom and dad are paying to the kids is also a gift, free of gift tax. So mom and dad continue to enjoy the property, pay rent. That transfer reduces their estate. Everybody's happy. On the installment sale, same thing. You could do the sale and the cash flow could come back to mom and dad on the sale. So it doesn't impoverish them, especially if they're relying on this property for cash flow needs. And then I just throw in the last transfer here, kind of a tie to Mary and some of her comments that she's going to be making on 1031s. While not directly related to Prop 19, certainly 1031 exchanges can be effected between related parties if certain conditions are met. So we could have a situation where mom and dad could sell maybe a fractional interest in some real property, even their, well, I'm going to say their personal residence, but let's just say it has to be qualified property. If they were to divvy up the income producing property and sell a fractional interest, they could actually qualify for a 1031 exchange if they sold to their kids, as long as, again, certain criteria were met. Kids didn't dispose of the property in 2 years, that type of thing. So there are some alternatives. Ryan, did you want to just briefly talk about intentionally defective grantor trusts?
Yeah, let me briefly talk about them, because there's a question in the Q&A that says, what if our children are minors? Well, this is the vehicle to use it for, something similar to this. And this term, intentionally defective grantor trust, my world, this is a complex estate planning tool. We love our acronyms. So this is a trust. It's an irrevocable trust. And it's called defective grantor because we build in a defect to this type of irrevocable trust where the grantors, mom and dad, are going to be considered the taxpayers for the trust. So you can form an irrevocable trust for your children. And we do the gifting or the sales of those real property interests or the LLC interests, we do it to these trusts. So the children are the beneficiaries. We have a trustee who's managing these funds, but mom and dad are the taxpayers for the trust. So mom and dad are still paying 100% of the taxes for the property or the LLC, which is actually another tax-free gift, right? Because that's just the way these grantor trust rules work. So because they're paying the taxes on behalf of the trust, that's a very powerful planning tool as well. The trust itself can obviously accumulate for the benefit of the beneficiaries. So we can accumulate income, allow those assets to grow. Oftentimes, we've used estate tax exemption to exempt this trust from a future estate tax, which means that it can grow estate tax-free, another powerful planning mechanism. And we give the grantors usually the right to substitute assets. So you can decide to put this LLC with the property inside this trust for gifting in 2021. What about 3 years down the road, you need that property back and you have other sufficient assets. You can substitute assets out. And that's a tax-free transaction as well. So there's a way to even do future planning down the road to have some flexibility built in to be able to accomplish your goals. And so the good thing is once you gift these assets to this trust, that means the assets inside the trust are outside mom and dad's gross estate. So this is really estate tax planning. And as Tim just said, we have $11.7 million of exemption per person right now. But very soon, maybe this year or next year, that exemption could very well go down to $3.5 million per person, maybe $5 million per person. We're going to find out what Congress is going to try to do. Mm-hmm. So individuals who are in that $10 to $12 million total estate range could very well find themselves in an estate tax problem very soon. This is where these types of complex techniques come into play. Mm-hmm. And this type of trust, and really this trust combined with the planning I mentioned earlier, it is complex planning. So it's a process. I don't want people to feel like this is something they rush into. It's just something that we discuss, analyze, and we come up with various tweaks and options for them. So if you're interested in this type of trust, obviously reach out and I can give it a more full explanation of how these types of trusts work.
Yeah, the reason I like this technique, there's several reasons, but one of the difficulties that we have planning with clients is, do we gift now at the expense of not allowing our beneficiaries to get a stepped up basis in the property that we're gifting on death? Because remember, that's what happens. When you die, your assets, if they're included in your estate, are valued at the fair market value on the date of death. And then your heirs inherit that stepped up basis. So if they go out the next day and sell the property, they don't have a gain. Well, the price that you pay for that is if you're in a taxable estate. So if you die and your assets total more than your allowed unified credit amount, again, that's $11 million today, but it could be $5 million, tomorrow. Now you're paying 40% estate tax on the assets that are included in your estate. So yippee, my heirs got a stepped up basis, but they had to pay 40% to get it. So there's this trade-off between, do I roll the dice and leave the property in the estate such that if I die, it'll get a stepped up basis, or do I give it away now and forego that stepped up basis? The nice thing about the IDGIT is that the defect that allows it to be taxed to the grantor is this ability to substitute assets. So prior to death, let's just say that I transferred a low basis asset, gifted a low basis asset to the IDGIT, and I would like that to be included in my estate. I can just simply substitute cash or another asset into the IDGIT prior to my death, get that property back out, and now it'll be included in my estate. So it gives us the maximum flexibility. Anyway, we could go on and on about IDGITs, but I want to continue on with the planning ideas. So some of the things that we should be considering when we're transferring these, even among family members, is you got to do what you said you did. So like in the situation where I had mom and dad, they actually gifted their residence to the idiot, in this situation, and then wanted to live in it. Well, they don't own it anymore. So what did they have to do? Well, they had to pay rent. And you'll have to pay rent to the idiot, fair market value. Now, the fortunate thing about the idiot is, since it is a grantor trust and this is only respected for estate tax purposes, the rental income that you're paying to yourself is not taxable. It's a tax-free gift to the kids, but it's not taxable. So, but you do want to have a rental agreement. You're likely want to maybe even, I don't know, open up an escrow and transfer the property. Certainly you want to do that if it was a sale. You might actually want to buy title insurance for the transfer. And something that a lot of people I think miss is they're no longer the homeowner, they're a renter. You may want to look at your policy and up your renter's insurance or apply for renter's insurance. So there are certain little particular things that you need to pay attention to that, again, will overcome an assumption that you just did this as a scam. And you really need to abide by those rules. So I just want to remind everybody of that. So in the time remaining, we do have Mary. I guess at this point, Jennifer, it might be a good point to ask if there's any questions on Prop 19 that we can answer live, or if they've been chatted in, great. Otherwise, I want to roll in and
yeah, we've got a bunch of stuff that's come in through the Q&A box. If you guys could maybe tackle some of those, that would be great.
Okay, well, while she is doing that, I'm trying to figure out how I'm going to do that and run the slides at the same time here.
I got it. I answered a couple questions already, but I'll just hit them back real quick. So how long does a child need to live in the home under Prop 19? That as Prop 19 works, we're waiting for guidance on that. That's one of the key areas we're waiting for guidance on. People like myself, other professionals, we've been talking, we think it's going to come down around a 2-year minimum time period. But again, we're waiting, we're hopefully to find out before summer, hopefully. Another question is, what about, are husbands and wives, spouses considered transfers amongst each other for these planning options I mentioned? No, they're considered one owner. Husband and spouses are considered one owner. If it's community property, if it's separate property, it could be a different answer, but most of the times if we're going to do this type of planning, we'll convert it to community properties so we can deem them as one owner. And another quick question is, what if there's only one child? Because I did say in my scenario, that example I gave you, this works if there's more than one child. Well, if there's one child and the child is 50% LLC interest owner and parents are 50% LLC interest owner, when that parents transfer their 50% to the child, well, now that one child has crossed the 50% threshold because now they own 100%. That is considered a change in control, which triggers change in ownership, which triggers reassessment. So that type of planning really only works if you have more than one child. If you only have one, then we would have to probably look at more of like a tax mitigation strategy as far as property taxes are concerned, where we could definitely save the 50% reassessment, but it's probably going to be very difficult to save the 100%.
Well, I suppose in that scenario, Ryan, if child was married, child could transfer a portion of their 50% interest to their spouse or maybe to their kids. And now they could accept gifts from mom and dad of the entity and not cross that 50% threshold.
That is possible for sure.
All right, well, keep chatting those questions in. We'll monitor those. Mary, do you want to take it from here?
Yes, of course. Thank you, and good morning. Thanks for inviting us to participate today, Tim and Ryan. It's great to see you. My colleague Teresa Flugel is on with me as well, and we're just going to talk very briefly about some final regulations that were issued in December regarding the definition of real property for purposes of Section 1031. So as you may recall, back in 2017, the Tax Cuts and Jobs Act specifically modified Section 1031 to eliminate the ability of a taxpayer to exchange personal property, intangible property, and collectibles. So the 1031 now is restricted solely to the exchange of real property that's held for investment or for use in a trade or business. Real property had never been defined for 1031 purposes, although it is defined in other sections of the code for other purposes. So the IRS and Treasury issued some proposed regulations back in June of last year, which they received a number of comments on, and then they finalized the regs and issued them in December of this past year. Here's what they say basically. A lot of the proposed regs initially said, look to federal law only when you're trying to determine whether or not the property you're selling and acquiring is real property. And a lot of commentators took issue with that and said that really we need to make sure we can look to local law and or state law when we're trying to determine whether the property is real property or not. And this goes back to a chief counsel advice that was issued a number of years ago, almost a decade ago now, where there were some natural gas gathering pipelines that were in one state personal property and in the adjacent state they were real property. And so at that point, you know, they would not have been considered like-kind properties if you look solely to federal law. So the final regs did capitulate, and they say you can look to state and local law to determine whether or not the property is real property. I want to just make one more comment on that, Tim, before we go to the next slide, which is that the regs really do only address whether the property is real property or not for 1031 purposes. They do not in any way address whether the properties are like-kind to each other. So that's a whole different kettle of fish, but it is nice to have the flexibility to look at local or state law for our definition here. The proposed regs initially did impose this income generating test where they said basically that any machinery or structural components that are attached to inherently permanent structures would be considered to be real property. I'm sorry, would not be considered to be real property if they were used in the generation of income. Tim, I don't know if you have thoughts about why that rule was initially proposed, but it seemed really strange to me. What the final regs say, they abandon this income generating test. And what they do say is there's 3 different ways you can determine whether or not your property is real property. There's the state law test, there is the listed assets test, and then there is the factors test. And if we go to the next slide, the state law test just says what I just spoke about, which is that if the property under state or local law is real property at the time of the exchange, then it will be real property for 1031 purposes. So that's a pretty easy one to talk about. The listed assets test on the next slide, there's a long list of assets that are set forth in the proposed regulations. And it starts with land and improvements to land, which improvements to land generally mean inherently permanent structures. And then also structural components that are attached to inherently permanent structures, such as walls and partitions, HVAC systems, plumbing fixtures, that kind of thing. These things are all considered to be real property. You can still look at the proposed regs and see that pretty exhaustive list of what is real property for 1031 purposes. And then the third test, if your property does not qualify or fall within the state or local law test and or the listed assets group, you can look at the factors test. And the factors test says you want to consider the manner and the expense that was incurred in installing this sort of structural component that's part of this larger inherently permanent structure. Think of a 3D printing machine, or one example in the regs talks about a sculpture in the atrium of an office building that was specifically placed in that atrium at great expense, and it weighed, you know, they had to do some extra reinforcement on the floors to make sure the structure, the sculpture itself would be safe and not damaged at all. You want to think about whether or not the structure itself or this component is designed to be moved. If it is not, it's probably going to be considered real property. Think about whether there would be damage to the structure, the component itself, and the building, the larger building, if the item was actually moved. So if there's great damage that could be incurred, it's probably going to be real property as well. So there you have it, the 3 factors, the factors test, the listed asset test, and then the state and local law test when you're trying to determine if the property is real property. Finally, the regs provide a little bit of a safe harbor for investors who are buying real estate that contains personal property. If they are concerned about using their proceeds from the sale of real property to pay for some component of personal property that is typically transferred along with the larger item of real estate. And what this says is basically, as long as the personal property that's transferred along with the real estate doesn't exceed 15% of the total fair market value of the property, it will be an okay expense. So using proceeds to pay for that personal property will not disqualify the exchange or create a G6 violation, which means that it would otherwise invalidate the entire exchange. Paying for that personal property may cause taxpayer investor to have some gain to recognize, some boot, but it won't otherwise blow up the entire exchange. So that was a nice outcome for us to have that nice rule.
So
The
Mary,
regs,
it occurs to me that couldn't that whole rule just simply be avoided if we wrote two separate contracts, one for the sale of the property and one for the sale of the personal property?
yes.
Okay.
I mean, absolutely, Tim. I think that's right. But you'd have to do the same thing on the disposition side, right? And I think sometimes sellers and buyers are loath to sort of put a breakdown of estimates of what is personal property versus what is real property. But absolutely, we have
Okay.
some investors who do separate those components, and they take the cash from the personal property at the closing on the sale, and they deal with all of that separately from the real estate. Yes, absolutely right. On the legislative front, back in almost about a year ago now, when President Biden was at that point just on the campaign trail for the presidency, he put out a document proposing to eliminate like-kind exchanges as well as other sort of preferential tax treatment. We have been in touch with a lot of legislators that are close to the president and who are influential on both the Ways and Means Committee and the Senate Finance Committee to talk about the importance of Section 1031 to the economy overall. I will say this about the initial proposal, which was that it was issued prior to the pandemic and when the president was still just a contender on the campaign trail. Not sure right now that eliminating 1031 is the highest priority of the Biden administration. They have a lot of other things that they're dealing with. But if you've been paying attention to the news, you know that the Democrats, now that they control both the House, the Senate, and the White House, have the ability to use the budget reconciliation process to enact legislation, which is exactly what happened in 2017 with the Tax Cuts and Jobs Act. The Republicans did the same thing, where they don't need to engage the other party, and they can simply write, through the budget reconciliation process, create sort of new law. So we are actually very tuned into this, and through our trade association and other real estate trade associations, we have re-upped and have started to renew 2 economic studies that we had commissioned back in 2015 and 16. The Ernst & Young study is a macroeconomic study that will sort of look at the effect on GDP of the repeal of Section 1031 on the economy overall, as well as some ancillary businesses like title insurance company, mortgage brokers, et cetera. The Ling-Petrova study is a microeconomic study that was also originally commissioned in 2015-16. That updated study looks at commercial real estate transactions over the course of a decade from 2010 through June of 2020. And their goal is sort of to figure out on a micro level what would happen to real estate, commercial real estate, if 1031 was eliminated. And their initial study and the draft of the new study that I've seen does conclude that if 1031 was eliminated, there would be a great lock-in effect generally in commercial real estate. People would continue to hold on to sort of suboptimal assets for some period of time. Rents would likely rise, as would leverage on replacement properties. So we are arming ourselves with some really good quantitative, qualitative data that we can present to lawmakers and other, policymakers who are influential to help us ensure that 1031 is retained in the tax code. There is a website you can visit if you are interested. It's www.1031taxreform.com. You can send a letter to your elected representatives, encouraging them to retain Section 1031. And you can also share your experience, if you wish, with our trade association, which is called the Federation of Exchange Accommodators. That website is 1031.org.
All right.
Thanks. Yeah.
So we are just about at the 10-minute mark here. till the end of the seminar. Jennifer, do we have any other, oh, I skipped a slide here. I'm sorry.
That's okay.
Yeah.
It's just a little bit of overview of who we are and what we do. And
Yeah.
where I'm based in Chicago, and my colleague Teresa Flugel is there in the Bay Area. We've been in the business together quite a while. So we are always happy to talk about 1031 related issues. If you have questions, feel free to reach out to us.
Thank you. Thank you, Mary, and thank you, Ryan. I guess I can.
Questions in the Q&A. If we have time, I can address a couple of them publicly.
Certainly.
Okay. So one question was, for the good part of Prop 19, meaning you're over 55 and you want to transfer to a different part of the state, is there a time requirement for the low basis property being your primary residence? And the answer is we are waiting on guidance on that part. I do know that one key component of the analysis is the property that you're about to sell your primary residence, does it have the homeowner's exemption on it? That could be a clear indication to the county that, yes, you intend this to be your primary residence. But we do have we are waiting for some guidance on this point as well. And let's see. Tim, you want to talk about step up in tax basis on LLC interests?
Sure. What was it, a specific question in the Q&A or the chat?
It was in the Q&A. It was basically in my example, when the parents die with an LLC interest, does that LLC interest receive a step up in tax basis as well?
Yes. So if the LLC interest is in fact included in the estate, and again, in estate planning, remember, we're always kind of planning for the second to die, because transfers between spouses are exempt under the unlimited marital deduction. But even in that scenario, if mom and dad were alive and dad died, mom now inherits the LLC interest, then yes, there would be a stepped up basis in the LLC interest itself. And with a proper election, we could actually then impart that stepped up basis to the assets of the LLC as they relate to mom. So that is a special provision in the partnership code that allows us to get that inside basis step up. So yes.
Good. There's another question about the effective date for the good part of Prop 19. That is a different effective date technically. So it's April 1st, but that does not mean that you can't sell your home until April 1st, or you can't acquire your replacement property until April 1st. This is the one piece of guidance they have issued under Prop 19, and it says all the April 1st deadline means is you can't apply or make your claim for the Prop 19 transfer until April 1st. So if you sold your primary residence in January and you're acquiring your new replacement property in March, you just have to wait till April 1st to send that form to the county to say, transfer my property tax bill from my old house to my new house. So that's how the deadline works for the good part of Prop 19. Okay. Here's one question that I'll bring in Mary as well. Does it make sense for the children to do a 1031 exchange upon the parent's death to a different, more tax-friendly state like Arizona or Nevada? I say yes, it absolutely can make sense. If the children are not interested in being property owners in California, or they just want to avoid California taxes in general, as soon as they inherit the property, they absolutely could do a 1031 exchange.
Of course, if they inherit at a stepped up basis. Oh, I'm sorry.
I was just going to say, it depends on if they have a gain or not. They may not need to do a 1031 if they inherited a stepped up basis. If they did receive the property prior, under one of Ryan's techniques and didn't receive the step up, then yes, they would be allowed to do that.
Yeah, I want to make one comment on that too, which is that the California Franchise Tax Board does require that if you trade out of California property in a 1031 exchange, you have to continue to report back to them regarding the status of that replacement property. And when that replacement property is ultimately sold, whether it's in a subsequent exchange or a taxable sale, you get to pay California for that deferred gain. So there is a little bit of reporting that's required there.
Yeah, and if you fail to report, there is a penalty for not reporting it, and the gain is immediately recognized in California.
You gotta love California's long-arm jurisdictional statute.
Yeah, don't we all?
Okay, let's see if I got anything else. There was a question here about, I can't quite understand that question. So it says in my example, when the parents die, do they still have the property tax base changed or the fair market value? So it really depends on the scenario. So in my scenario where mom and dad had 50% of the property still, if that when that 50% transfers after their death, that would be reassessed, assuming that we can't comply under Prop 19. But if it's the LLC that is being transferred, and it's only a 50% interest, and that I'm saying the new LLC, then we could still avoid property tax reassessment on that 50% transfer of the LLC because we haven't tripped either of those two rules that I went over today. So again, we got to plan this out, and we got to make sure that we're going to comply with all the rules along the way. But it is available, and it's an option if the parents and the children. Well, I should say if it makes sense for the family. But sometimes these transfers don't always make sense because we have to look at the other tax considerations, and it is a balancing act, like Tim said. Really, like the last month before Prop 19, most of the analysis I did was, does this make sense? Are we going to trade off the step up in tax basis for these property tax savings, and how does that work? Is it, how long is it going to take for the children to own this property for it to start to balance out? And sometimes the answer was 25 years. They might have to hold the property before they made up the same amount of property tax savings as they would have on the step up in tax basis.
Yeah.
So every situation is different. And that's why you need, advice and counsel to make sure that you're doing the right proper thing for your family.
Yes. Yeah, you can't do these in a vacuum. If anything, any good that came out of Prop 19, it got our clients, interested in estate planning again, right? I mean, oh, gee, I got to do something. What do I do? Well, it's just a small piece of your overall estate plan. That and the expiration potentially of the $11.7 million unified credit amount is a real motivator, I tell you.
Well, there's a lot of variables at play. And
yeah,
as Mary talked about, 1031 was targeted, at least at some respect. The step up in tax basis is being targeted in some respects.
That's right.
The gift tax or the estate tax rate is probably going to go up. As Tim
Capital
said,
gains. Capital
gains is going to go up.
In fact, this is a great opportunity, and I'm sure Jennifer will appreciate this. So we are going to continue on with a series of real estate seminars. This was actually our kind of maiden voyage of, one in a series. We are planning one in March, Jennifer, is that correct? March?
Yes, we are.
So it is likely,
yet, but it's coming.
The topic of that will be, what do we see coming down the pike as far as some tax changes? So we will try to interpret those. Love to have any of the panelists back with their opinions if they'd like to do that. But yeah, stay tuned for that. So I think we're at the 10 o'clock mark. If we didn't get to your question, we apologize. If you'd like to send an email with that question, happy to answer it offline. Again, thank you for joining us, and have a wonderful day. Hope to see you next month.
Yes,
thank you.
Yes, you guys will all be recording. We'll be recording this and sending it to everybody along with a copy of the slide deck. So you'll be getting that a little bit later today. Thank you for joining, everybody.
Thank you.
Thanks.
Thank you.